Welcome back. You're watching Crystal Ball. I've been in conversation with Manish Chokhani of TPG and INAM. Right now, how are you playing it then? Because you look at private equity as well, and midcaps have done really well.
Right.
Is it that kind of market where you cherry pick midcaps and hold till the music is playing, and that is the place where you'll get the best returns from?
So, well, as you're rightly saying, there are two hats. So on the public markets, it's fairly easy as an individual investor. You want to play consumption. You don't necessarily want to play, infrastructure and, the more asset-intensive businesses.
That's what you're doing with your personal portfolio?
Although there is a case to be made for some, large assets which are hard to replicate and whose asset values are selling at 25-30 cents on the dollars. For example, I've spoken to you, I think, earlier about hotels.
Sure.
If the entire Oberoi chain or the Indian hotels chain is available at a, $400, $500, $600 million range, it can't be the case that someone else in the world doesn't come and make a play for it, which indeed did happen in East India Hotel. So leaving things like that aside, you're better off in businesses which are asset light and nimble and which can run a lot faster.
Would you say the same of people owning large infrastructure assets, not hospitality? I mean, airports, ports, those kind of things?
Those assets have been built really well, but I don't think they've come in at the right prices. So it's like Buffett used to say, I applaud the effort, but I'll skip the ride. I think the play there which we are missing as a country is really in the domain of the government. That the cheapest way to build infrastructure assets is to use sovereign credit, because the government is the cheapest borrower. Instead, we are loading the cost of building those assets on private players who just cannot get equity at a reasonable price, and to whom lenders are increasingly diffident to lend to. And the way the government should be playing this, in my view, is you create assets at book value, get them up and running, and you sell them at 2.5 times book. And you keep that virtuous cycle going. So one is not saying you dismantle the public sector, but you cannot create a public sector and they just keep holding on to it, and then say new assets will be public-private partnership, where it's difficult for people to put those projects up and take all those delays and execution risks. And I think we will make a lot more money, substantially a lot more money, by playing it in this manner, where the government keeps on building and selling assets, rather than the way we are selling in dribs and drabs through disinvestment. So imagine if the government were to sell, the airports they own, instead of saying we will privatize it and hand it over to, party X to build a new airport. You'd make a lot more money out of it. If you take care of the ports in India, you take care of, the minister has spoken about securitizing road assets. Why would you want to securitize it? Why don't you just give it over to somebody else to run? Take the money, build the next level, sell those at 2 times book. So these hard assets, there's a big play in a world where there's 1% interest rates and all these sovereign funds are dying to invest in annuity type projects. That's the market to address with the assets we have. Somehow I think we are mixing up the two in India, but anyway, we'll leave that topic for another day.
But are you happy with what you've seen from the government so far, just to come back to this point, or would you have expected more? Well, you always expect more, but when you think of it, this has been run in a very mature manner, that you don't come in and start with all guns blazing, because you have to assess what's the ground reality, because you weren't inside to see what was happening while you were in the opposition. So I think stage 1, you must assess what is actually on the ground. Stage 2, you have to get work done by the same machinery and the same bureaucracy, which was effectively paralyzed for the last few years. So to get that lay of the land done in the first couple of months is actually right. I think conceptually the subjects that are being picked up. So how do you move this country forward is you will need a lot of skill development, you will need a lot of manufacturing to happen, you will need a lot of export clusters to get created, you will need to revive the whole energy chain, you will need to revive the whole mining chain, you will need to build infrastructure on ports, roads, airports, urban infrastructure. So the issues being picked up are absolutely right. I don't think I expected in the first 100 days they would come with solutions to everything. I think the ideas are all there. How to get this rolling, I would be surprised if in the next 100 days you don't see a lot more flesh and bone. The way you're running your personal portfolio, you said consumption over any other theme, but what kind of consumption were you talking about?
The way I'm thinking is there will be trouble in the world at some point, but beyond the trouble in the world still survives and the world still consumes. And what in some sense are the certainties in the world then? other than death and taxes. The certainties are that the billion people in India will consume. The billion people in India will graduate from their toothpaste and their soaps and all to buying more cars, to consuming a lot more data on their telephony, to using the net a lot more for their shopping purposes and so on. So that, what I call as consumer non-discretionary within the consumer basket, is a lot more interesting. Number two, the whole area of healthcare, pharmaceuticals is going to be very, very large in India. You cannot have a billion young people coming of age and not requiring a lot more healthcare, because that's something we may not have spent time on. So largely I would put consumer non-discretionary, healthcare, a few interesting kind of consumer companies, may not necessarily be the $30-40 billion market cap companies, but the smaller ones. It's certainly very interesting space to look at.
Valuations are okay in that space still?
Well, I don't have that kind of money, right? So with the limited money that I have, no. So there's enough to do over there. And I think banking in India, the whole space, if you're seeing the rate cycle going down, and the fact that it has to get built up, and a lot of these people will have bond portfolios which will benefit from this whole duration play, and the assets actually get better as rates go down and the economy revives. So the whole banking financial sector space looks extremely exciting.
What kind of bank? I mean, public sector?
Well, I mean, from a long-term investing perspective, you want to know who you're investing with. So that cannot, by definition, happen in the public sector. So my investments, of course, the investments will be in private sector. But the public sector, for example, State Bank looks very interesting right now. If indeed what we are seeing happens to the economy, that looks very, very, very interesting.
You said financial services. Do you see value or opportunity in the non-bank financial space?
Yeah, there's still lots. I mean, including the largest one, HDFC. It's not an expensive stock. So if you go all the way down from there, there's enough to do over there.
What do you hear when you interact with investors overseas? Is India just part of the overall emerging market space where money is sloshing around because it's getting printed, or have you heard a different strain over the last 3-4 months?
I think there is a renewed sense of optimism about India because it is seen as potentially a very, very large economy and a very, very large market, which in real terms has to deliver on its potential. I don't think we've seen even a fraction of the money that we can attract into India as yet coming in. And I say this consciously, knowing we've got maybe $25-30 billion of debt and equity inflows this year. I think we can get multiples of that. It is not conducive, though, to receiving this money. And I'll explain you from the FII perspective, and I'll explain it from an FDI perspective. On an FII perspective, the stocks you want to buy largely, and you would corroborate that, are largely at FII ownership limits. And we have this strange phenomena where, for example, in banks, we'll say you can buy up to 49% in India, and you can buy 24% if you do an ADR. I mean, these are funny laws, and they just should be done away with. And just make it fungible, say 74%, whatever number you want, come and buy it, do whatever you like. Company after company after company, you hit some limit here or some bottleneck there, and really the headroom is not in the companies where people would like to buy them. The supply is going to come largely from the public sector, which, unless there is a strategy to what the government intends to do, you will end up selling these assets cheap. So as an Indian, I feel disappointed about it. As a foreigner, I would see this, that if this country is going to get its act together, these may be interesting assets to own for the long term. From an FDI perspective, we still do remain, with all the good intentions on part of this government, and hopefully things will improve. It is a difficult place to do business. As a foreigner, I see as well now, when you do transactions, there's another new law which one has to comply with called the Foreign Corrupt Practices Act. And in India, it's very hard to find a business which is operating in the real environment, which will not fall foul of that law in some form and manner. So some of these things, I think, directionally, it's right that India will fix it, but I don't think it's ready right now. If you tell me India will get $50 billion in the next 6 months, it'll be tough.
Let me ask you to wear a hat which you don't wear anymore. I mean, away from private equity and HNI investing, the old brokerage hat. What's going on with retail investors? We are 25% above the previous peak. By this time, you would have seen signs of life, but they're still very, very nascent.
I wish I knew the answer. So because it's not like real estate or gold have delivered returns as well. Some of the answer, I think, lies in the fact that India is the only country in the world where you get rewarded for putting money in a fixed deposit in a bank. In the rest of the world, with the zero interest rate policies, you're being pushed to taking risk. India doesn't seem to have that culture of wanting to take risk. So we want convertible debentures in a sense, that I want my downside to be limited and upside to be open. Unless those kind of instruments are created, which is how in the first place Reliance created the equity cult in India. I think that may be the way forward. And again, if the government's going to do a lot of disinvestment, those type of instruments may be a lot more interesting to get retail back. I think otherwise waiting and wishing for retail to come, they're likely to come only when there's clear blue skies, when the valuations will reflect it. Because even now when we speak and we talk about potential blow up in the world and risks in the economy and difficulties of people having built assets 20 years ago and getting overturned, as an ordinary investor I would be really scared. So I don't blame the average retail investor. And having said that, the average retail investor has done really darn good in the last 10 years. Because they made money on real estate, they made money on gold, and they made money on their fixed income portfolios. So, maybe they'll turn out to be the smartest people in the end.
What would you advocate, though, in terms of asset allocation at this point, for people who are fairly underweight equities?
And honestly, I'm an equity person, so it's like asking a barber if you need a haircut. The reality is, though, it's a young country. And when you're young, you can take risk. As you get old, you can't take risk. And the reverse seems to be happening in the world, where the American and the Japanese investors are taking risk, who are the older demographic. And the Indians who are 25 years old are happy keeping their money in fixed deposits. So number one for most Indians, I would say, is go build your own business. And on the private equity side, I see stunning characters coming and building young companies. And that keeps me renewed and excited. So as a young Indian, first try and build your own business, because the potential is large. Our country will be 2 to 3 times in size in the next 10 years. Number two, you must have, at least if you're 25 years old, you should have 75% of your money in equity, 25 in fixed income. And as you become older, I'll be getting 50 shortly. I should be half and half in equity and debt.
You're 100-0.
I'm 100 and I wish I could be 120-0. So, but wealth is not going to be created by fixed income. Wealth has to be created by taking risk and showing some enterprise.
On that note, always a pleasure, Manish. Thank you very much.
Thank you.